The SEC's recent actions in the crypto space have been closely scrutinized since Gary Gensler took the helm in 2021. Initially perceived as a threat to the crypto industry, recent legal outcomes, such as the Ripple case ruling and the Grayscale successes, seemed to push the anti-crypto regulator onto the defensive. However, a recent hearing highlighted that the SEC, under Gensler's leadership, is far from backing down. This includes their pursuit of potentially problematic rules that could impact stocks and small businesses. Welcome back to the Finance Homefront with me, Bev. In this video, we'll break down the key points from the hearing and explore what it could mean for the markets. But before anything else, hit the like button. This encourages us to put out more financial content that can help you out one way or another. All good? Perfect. Let's go. The Senate Banking Committee hosted the hearing titled Oversight of the U.S. Securities and Exchange Commission just recently. The hearing commenced with opening statements from prominent politicians on both sides, followed by Gary Gensler himself. Sherrod Brown, in his opening statement, emphasized the risk of new technologies further concentrating power on Wall Street. He drew attention to the fact that megabanks and asset managers like JP Morgan and BlackRock could potentially wield significant influence over the crypto market. Brown also noted the 15th anniversary of Lehman Brothers' collapse, signaling concerns over a potential impending financial crisis. Despite expressing concerns about crypto's dangers, his tone was notably less anti-crypto than in previous hearings. Tim Scott criticized the SEC in various fronts, highlighting issues such as lack of transparency, illogical leadership, hostility towards innovation, and the focus on non-financial market-related concerns. Scott particularly criticized the SEC's climate disclosure rules, which could substantially increase compliance costs for publicly traded companies. When Gary Gensler took the floor, he clarified that his views are personal and not necessarily reflective of the SEC's stance. He stated that the SEC's rules have played a crucial role in the U.S.'s economic success for over 90 years. Gensler used the analogy of a gold medalist needing to keep training to retain their gold medal, suggesting that the SEC must continue creating new rules to ensure the ongoing dominance of U.S. financial markets. However, he didn't delve into specific rule proposals, emphasizing instead that the SEC values public feedback during its rule-making processes. Bob Menendez asked about the financial industry's use of AI, with Gary predicting AI's potential role in a future financial crisis. Menendez also inquired about diversity and inclusion and the rules for money market funds. Mike Round scolded Gary for not responding to his letters. Mike then revealed that the SEC's proposed AI rules would cover almost every kind of market analytics tool. Gary confirmed this, emphasizing that the rules would include any tool, even if it doesn't use AI, but provides predictive power to the user. This, according to Gary, is for investor protection, and it raises questions about whether crypto platforms might also fall under the SEC's oversight. Catherine Cortez Mosto focused on AI use by the SEC, expressing concern. Tom Tillis asked about the impact of SEC rules on market liquidity. Mark Warner expressed concerns about AI undermining trust in U.S. financial markets. Finally, Elizabeth Warren, known for being anti-crypto, surprisingly didn't ask about crypto. Instead, she questioned Gary about private equity, revealing that the private equity firms hold over $26 trillion in assets under management. J.D. Vance followed with aggressive, politically charged questioning, hinting at the partisan nature of the SEC's enforcement activities under Gary's leadership. Elizabeth Warren and J.D. Vance's lines of questioning revealed potential political bias in the SEC's actions. J.D. even suggested that this partisanship could change in the future, which might have implications for the crypto industry. Chris Van Hollen shared a fascinating fact that countries like China are heavily invested in U.S. private equity. Gary didn't seem concerned about this, stating that the SEC is neutral about where investors come from, as long as they follow U.S. securities laws. This creates an interesting dynamic in the global investment landscape. Cynthia Loomis is known as a crypto-friendly politician. In her turn, she focused on crypto custody by banks, the only custodians recognized by the SEC. However, despite this recognition, the SEC has cautioned banks against crypto custody due to regulatory complexities, requiring them to report it as an asset on their balance sheets. Cynthia challenged the logic of this rule, citing concerns about its impact on banks and labeling it as an excuse. She argued that the regulation places unreasonable burdens on banks. Next up was Tina Smith, inquiring about the timeline for the climate disclosure rules. Gary did not provide a specific time frame, but mentioned that it took approximately 19 months to finalize rules for open-ended funds. He emphasized that the SEC is not in a hurry, contrasting with upcoming ESG regulations in the EU, which might overshadow the SEC's rules once enforced. Katie Britt delved into the complexity of the SEC's rules around open-ended funds. She expressed concern that these rules, among other ESG proposals, reveal a lack of consideration for the average person, accusing the SEC of being more aligned with Wall Street. When she pressed Gary about a specific ESG-type rule, he mentioned that it would take time to work through the details. Katie urged the SEC to consider the effects of its rules on everyday people. Kristen Sinema questioned whether the SEC genuinely listens to small investors when crafting new rules. Gary claimed that the SEC reaches out to small investors through social media. A statement met with skepticism given the negative sentiments expressed on SEC posts. Kristen, unconvinced, challenged Gary's assertion about the effectiveness of the SEC's engagement with small investors. Steve Daines criticized the SEC and called Gary an unelected bureaucrat. He questioned how the SEC could pass rules without congressional authority. Gary explained that the rules fundamentally relate to disclosures, justifying their passage without specific congressional approval. Finally, Jack Reed probed Gary about private equity. He asked whether private equity poses competition for banks and if it is subject to the same requirements, specifically Know Your Customer or KYC regulations. Gary acknowledged the significant growth of private equity, surpassing the banking sector in size. When asked about concerns regarding Chinese and Russian nationals investing heavily in U.S. private equity, Gary stated that it's a matter for Congress to address, despite the SEC's proactive stance on various issues without explicit congressional approval. Now, let's talk about what all this means for the markets. It depends on which market we're discussing, and it seems like the SEC is influencing three main areas: the crypto market, traditional market, and the overall economy. Starting with the crypto market, Gary's testimony indicates that the SEC isn't done causing trouble. The comment about the industry still having issues with non-compliance suggests that the SEC will likely keep its attention on crypto until the entire industry follows the rules. The silver lining here is that the SEC has already taken significant actions, suing Binance, Coinbase, various crypto projects, and the NFT projects. While they could continue these actions, the market may have already factored in these challenges. The wildcard is the SEC stands on spot Bitcoin ETF filings. Gary has been tight-lipped about these applications, especially from big players like BlackRock and Fidelity. While it's assumed they'll eventually be approved, uncertainties remain about the changes the SEC may request, particularly in spot market oversight and crypto custody. Moving to traditional markets, there's growing tension toward private equity. Questions from politicians during the hearing suggest a conflict between private equity and the banking sector. Gary's background at Goldman Sachs and alleged destruction of banking documents related to the 2008 financial crisis may indicate significant influence from megabanks over the SEC. The seemingly puzzling rulemaking could be a result of a tug-of-war between these two factions, as speculated for years. The effects of the SEC's proposed rules on the stock market are uncertain, but some, like the climate disclosure rule, may increase costs, affecting profitability. ESG-focused asset managers like BlackRock could offset this decline in profits. However, rules impacting the stock market might bleed into the actual economy. Senator Tester noted that almost all U.S. farmers work with publicly traded companies, and squeezing them could lead to economic issues like inflation. These economic problems would then affect the stock market and eventually impact the crypto market. The good news is that most politicians seem aware of these interconnected dynamics, regardless of their political stance. However, the bad news is that the SEC has demonstrated a tendency to operate independently of congressional oversight, except when it aligns with Congress's objectives, like assessing foreign investment in private equity. This suggests the SEC might continue its regulatory activities until Gary's term concludes in 2026, or if he steps down for a more influential position, such as Treasury Secretary. A change in U.S. leadership in 2024 could also alter the SEC's course. What are your thoughts on these revelations? Do you think the SEC's actions are genuinely aimed at investor protection, or do you see other motives at play? Share your insights in the comments below. This info is just for learning, not financial, legal, or tax advice. Make sure to do your own research when it comes to financial decisions. And with that, don't forget to like, subscribe, and hit the notification bell for more updates on crucial financial discussions.